Treasury has a just $88 billion of measures left to avoid debt cap. Treasury Secretary has warned it may exhaust measures by early June. Yellen said US default would be economic and financial catastrophe. What is debt ceiling? Created by Congress in 1917, the debt limit or ceiling sets the maximum amount of outstanding federal debt the US government can incur. In January 2023, the total national debt and debt ceiling both stood at $31.4 trillion. The US government has run a deficit averaging nearly $1 trillion every year since 2001, meaning it spends that much more money than it receives in taxes and other revenue. To make up the differences, it has to borrow to continue to finance payments that Congress has already authorized. How often has it been raised? Raising or spending the debt ceiling becomes a necessary when the government needs to borrow money to pay its debts. Since 1960, Congress has acted 78 separate times to permanently raise, temporarily extend, or revise the definition of debt limit. 49 times under the Republican presidents and 29 times under Democratic presidents. House Republicans late last month passed a bill that would raise the $31.4 trillion debt limit by $1.5 trillion and delay the risk of a default until next year. The far-reaching effects are hard to fully predict. From shock waves in financial markets to bankruptcies, recession, and potentially irreversible damage to the nation's long-held role at the center of the global economy. The $24 trillion US Treasury market is the primary source of financing for government as well as the largest debt market in the world. The Treasury market is the backbone of the financial system, integral to everything from mortgage rates to the dollar, the most widely used currency in the world. At times, Treasury debt is even treated as the equivalent of cash because of the surety of the government's creditworthiness. The cascading impacts of default would probably compound. A pause in federal payments would hurt the economy, which would hurt the stock market, which would in turn hurt the economy even more, and so on. The interaction between collapsing home values, rising interest rates, and destabilized global financial system are hard to calculate. Some estimates suggest that more than 8 million jobs could be wiped out, mortgage rates might soar by more than 20% according to some projections, and the economy would contract by as much as during the 2008 Great Depression. There is a more than $1 trillion of treasury debt maturing between May 31 and end of the June 2023 that could be refinanced to avoid the default. What would be the potential impacts of default? Wall Street would probably be the first trouble spot. Stocks would be likely plummet on the expectation of a wider economic downturn as the interest rate rise and investors pull funds out of the market to preserve their access to the short-term cash. The last time the US government near default, stocks took a bruising. In 2011, the ex-date was less than a week away during a standoff between President Barack Obama and Republicans in Congress. Major indexes fell by roughly 20%. Moody's Analytics has estimated that stock prices could fall by roughly one-fifth, wiping out $10 trillion in household wealth and devastating the retirement account of millions of Americans. The White House has estimated that decline could be closer to 45%. The $46 trillion bond market would also tremble as the value of existing treasury bonds collapse due to higher yields on new ones, and businesses would likely halt expansion, driving stock down even more. It may cause a sudden recession. A recent report from Zillow projected that a default would drive mortgage rates above 8% and push housing sale down by a startling 23%. The construction industry and other sectors would feel the pain too. The most drastic impact might be a pause in regular federal payment to tens of millions of American families, including seniors on Medicare and Social Security and people relying on food stamps. As 2013 report by the Treasury Department found that 2011 debt ceiling standoff caused a $2.4 trillion decline in total household wealth. The broader economy, the White House Council of Economic Advisors said, could contract by a much 6%. The federal government is the largest employer in the country with roughly 4.2 million full-time employees. Social Security and Medicare miss payments. More than 60 million people receive monthly Social Security payments, mostly seniors. A similar number depend on Medicare for their health insurance. Some Republicans have claimed that the federal government can continue making these payments even without borrowing by redirecting income tax revenue, but budget experts are skeptical the Treasury Department will have the ability to send seniors these benefits on time. US borrowing costs soar. The federal government is able to borrow money relatively cheaply because it's seen as a very safe credit risk. No one in normal circumstances expect that it might miss any payment. The safety of US government bond has made them an essential building block in world financial system, serving as reserves for everything from foreign nations, central banks to money market funds. US Treasury are widely recognized as one of the most secure and liquid investment available, backed by the full faith and credit of the US government. Any financial instrument whose value is based on Treasury bonds could be thrown out of whack after a debt ceiling breach, with a sharp drop in prices leading to volatility and uncertainty worldwide. Many nations safeguard their finances by buying large amount of US government debt, widely regarded as one of the safest assets in the world. But breaching the debt ceiling could drive the value of those bonds down, hurting reserves for many nations. Foreign investors and government hold $7.6 trillion or 31% of all treasury debt, making them vital to the favorable financing condition that the US government has long enjoyed. But after a default, the perceived risk of holding treasury debt could rise, making it more costly for the government to borrow for the foreseeable future. The dollar's central role in world may also be undermined. Economically, according to the forecast by the White House, even brief default would result in 500,000 lost jobs and somewhat shallow recession. A protracted default would push those numbers to a devastating 8 million lost jobs and a severe recession, with economy shrinking by more than 6%. What are the demands of the Republicans? Budget cut. Proposal would cut domestic spending by $130 billion. Republican conservatives are demanding at least $3 trillion in spending cut over a decade in exchange for supporting an increase in the debt ceiling. The group also is demanding an end to Biden's students loan forgiveness program, rescinding unspent COVID funds, and rescinding both the $80 billion expansion of the Internal Revenue Services enacted last year and climate change spending from the Inflation Reduction Act. Former President Donald Trump urged Republican lawmakers to let the United States default on its debt if Democrats do not agree to spend cuts. Please like and subscribe my channel. Thanks for watching.